When handshakes turn into tariff blades, the question is no longer who wins, but who's left to negotiate. In the summer of 2025, as President Trump continues to unleash a barrage of tariffs on Canada, Europe, and Mexico, America's former allies aren't getting angry. They're quietly walking away. No longer trusting Washington, they are reshaping global trade without the U.S. at the center. And what's unfolding isn't just a trade war, but a strategic divorce in silence. Empty chairs at the negotiation table. No one left with a knock on the door. No gates slammed shut. But one by one, the chairs around the negotiation table are slowly becoming empty. The trade relationships that were once a point of pride for the United States, built over decades of alliances, negotiations, and trust, are fracturing not because of a sudden shock, but because of the continuous erosion brought on by confrontational policy. The summer of 2025 is not just a season of new tariffs. It is a season of quiet withdrawals, of strategic decisions made behind closed doors in Ottawa, Brussels, and Mexico City. And while Washington continues to send letters, continues to invite dialogue, what remains at the table is the absence of trust. This is unprecedented in the history of post-war American trade. The United States used to be the anchor of the global system, not only because of its economic strength, but because of its consistency in dialogue. When America signed free trade agreements, it didn't just facilitate the movement of goods, it built trust in a system that all sides could rely on. But today, with tariff letters sent without warning, with a sweeping 35% duty erasing all preferences on Canadian imports, with a threat of 30% for the EU just as talks restarted, the U.S. is no longer the guarantor of that system. It has become the unpredictable factor, a variable forcing countries to recalculate their entire economic models. Canada was the first to feel the shift. For decades, the entire structure of the Maple Leaf Nation's trade had been built around its southern border. But when letters from the White House came down like wartime warnings, policymakers in Ottawa began to realize this wasn't a temporary glitch, but a fundamental change in how the U.S. treats its closest partner. There was no angry press conference, no fiery rhetoric. Instead, there were deliberate moves, redirecting exports, signing new agreements with Asia, reopening talks with India, and silently stepping away from the table that once stood at the center. The European Union behaved differently, but the motivation was the same. No longer betting on the reliability of a partner willing to turn every disagreement into a punitive threat. The EU didn't walk away from the negotiation table. They left their chair in place, but empty. Negotiators from Brussels still flew to Washington, but with each trip, trust eroded further. No one said it aloud, but all understood. This was the clinical phase of the transatlantic relationship. Drafts of retaliation measures worth tens of billions of dollars were already prepared, not for immediate use, but as a signal. If necessary, they would not hesitate to move forward without the U.S. Mexico hasn't withdrawn, but it's no longer moving forward either. Negotiations continue, but not to expand, only to preserve what's left. No trust is strong enough to survive an environment where terms can be ripped up by a single tweet, where trade commitments can vanish with a letter stating effective August 1st. Meanwhile, in Washington, the White House still believes pressure will bring everyone back to the table. But what they fail to see is this. Pressure doesn't bring partners closer. It forces them to build other paths. Every tariff isn't just a financial burden, but a reminder of uncertainty, of political risk embedded in every export contract. And no one, no government, no business can plan for the future on a foundation of volatility. What's the result? There's no joint statement declaring a breakup, no banner declaring the world is leaving America. But with every redirected order, every Asian port receiving more Canadian containers, every European company adjusting its supply chain, a new reality is taking shape. The global trade table still exists, but the U.S. is no longer at the center. And once that empty chair gathers dust, the question is no longer who will fill the gap, but whether anyone even needs it anymore. The price paid on home turf. As seats at negotiation tables gradually emptied, the consequences didn't just come from abroad. It wasn't just about other nations quietly pivoting away from the U.S. The more troubling signs were emerging right on American soil, inside warehouses packed with overpriced inventory, on supermarket shelves bearing numbers no longer easy to accept, and in the psyche of a market already fragile from years of ongoing instability. The day the letter announcing a 35% tariff on all Canadian imports was made public, without a press conference, without any diplomatic message, was the day American market analysts began marking red flags on already cautious growth forecasts. Not simply because Canada is America's largest trading partner, but because the supply structure between the two countries isn't a simple import-export chain. It's deeply integrated. When a stream of raw material from Quebec gets taxed, a production line in Ohio stumbles. When a softwood lumber contract is delayed, construction costs in Texas spike. The blows aimed outward by Washington, in the end, ripple back like waves rolling in reverse on a turning tide. In June 2025, when the 50% tariff on refined copper took effect, the U.S. electrical and tech manufacturing sectors found themselves cornered. The U.S. imports more than half its copper from partners like Canada, Chile, and Peru, once reliable allies. Yet the domestic refining industry has never been a government priority. The result? Input prices surged, but supply didn't. Factories had to choose between two scenarios: either absorb the new costs and slash profit margins, or pass the burden on to consumers in a market already hypersensitive to pricing. And it wasn't just copper. Coffee from Brazil, a product the U.S. cannot self-sustain except for a few farms in Hawaii, was also hit with a 50% tariff. One doesn't need to be an economist to see what happened next. The price of a morning coffee at every Starbucks, Dunkin', or Brooklyn street corner went up, not because the global supply chain was disrupted, but because it was deliberately tightened by an executive order. Consumers began to feel the weight clearly. But what was more worrying was the mood in the business world. When companies can't predict the cost of materials for the next month, how can they plan investments for the next quarter? IPOs were postponed. M&A deals were abandoned mid-process. Medium-term investment loans were either denied or saddled with higher interest rates, because policy risk had become a variable no algorithm could accurately quantify. At the same time, the Trump administration, in a move full of contradiction, kept pressuring the Federal Reserve to cut interest rates. The stated reason: to support the real estate market and stimulate investment. But analysts knew better. The market wasn't short on money. It was short on trust. No low interest rate could persuade a business to invest boldly if they couldn't tell whether another tariff might land next week. At commercial banks, a new metric began to be monitored closely: the rate of late personal payments. As prices rose and wages failed to keep pace, Americans had to choose: pay down their credit cards or buy basic necessities. And when the choice began leaning toward the latter, banks realized the inflationary spiral driven by tariffs was morphing into a spiral of bad credit, the very fuse that had triggered past financial crises. None of this played out loudly. There was no press briefing admitting that the tariffs were backfiring. But in declining earnings reports, in weakening consumer data lines, and in the wary eyes of Wall Street investors, it was clear: America was tripping itself up. Not from foreign competition, but from a lack of stability within. And this is only the beginning. As major trading partners prepare to live without America in their supply chains, the impact will no longer be felt in the price of individual orders. It will be seen in the reshaping of consumption structures, the redrawing of global production maps, and, most crucially, the reevaluation of the U.S. dollar's role and American tech's position in international markets. If the empty chairs signal a diplomatic loss, then the red numbers on consumer receipts are the warning that consequences have already seeped into every kitchen, every storefront, and every financial report. When the tariff stick is swung too often, the hand holding it begins to lose its grip. Beneath the silent wave. As inflation indicators began to creep upward with each new tariff announcement, as the IPO market froze and businesses tightened their budgets, another shift quietly spread, one not immediately visible on any chart, but felt in every strategic decision: the retreat of investment confidence. There was no mass capital flight, no dramatic outflow from Wall Street, but behind closed boardroom doors, spreadsheets began to include a new column: U.S. policy risk, reassess required. This is the most dangerous consequence of the pressure-based strategy. Not the retaliation from abroad, but the internal erosion. Each industry, each sector, began to redefine its investment criteria. No longer was it, the U.S. market is too big to ignore, but rather, is it worth investing if every incentive can be wiped out overnight? A wave of tech mergers in Silicon Valley was put on hold. Not because the companies lacked potential, but because investors couldn't accurately estimate supply chain costs over the next 6 months. Electric vehicle manufacturers in Michigan, heavily reliant on imported components from Canada and Europe, were forced to delay new product lines as raw material costs rose 18 to 23% in just 8 weeks. Commercial real estate firms, already struggling to recover post-COVID, had funding cut off by major banks due to an inability to model long-term valuations. In a market economy, investment is the heartbeat. It doesn't need fanfare or flashy campaigns. But when that heartbeat falters, every other system is affected. And right now, tariff shocks are disrupting investment flows, both at the corporate and individual financial levels. The shock isn't only about tariff walls, it stems from the message coming out of the White House. Every time President Trump publicly criticized the Federal Reserve for not cutting interest rates fast enough, the market grew more unsettled. Statements like, "The Fed should act to offset damages caused by trade partners," not only reflected confusion in policy, but something even more dangerous. Washington was now using monetary policy as a patch for self-inflicted blows. Meanwhile, commercial banks began closely monitoring household credit indicators. As prices rose and job growth lagged behind, the number of people falling behind on credit card and mortgage payments began ticking upward week by week. No one wanted to utter the word crisis, but early signs of financial strain were surfacing. An economy like the U.S., heavily reliant on domestic consumption, cannot hold if consumers lose the ability to pay. Among investment funds, the question was no longer where to invest, but should we keep pouring money into the U.S.? It might sound dramatic, but within asset management circles, it was a real concern. When trade agreements are invalidated or left in limbo, when capital can't ensure returns due to legal and tariff volatility, even the U.S. market ceases to be an absolute safe haven. And the dangerous truth is that once these capital flows shift, they're incredibly hard to reverse. An assembly plant already relocated to Mexico, a data center already placed in Ireland, a battery supplier already partnered with Japan. These aren't short-term adjustments, but new strategic orientations. Each decision triggers a chain reaction in taxes, personnel, finance, and production, and rarely reverses just because Washington issues a new invitation. This is a quiet loss, but a deep one. It doesn't show up like a stock market crash or a single quarter's GDP decline, but through every delayed capital injection, every withdrawn investment project, every startup unable to raise new funds. America is slowly losing the most important, intangible asset in the global economy: predictable stability. As President Trump continues to impose tariffs and pressure both trade partners and the Fed, he may believe he's playing hardball to restore fairness. But the real cost isn't paid by the other side. It's being tallied with every decision investors quietly make: reducing U.S. exposure in portfolios, pausing long-term investments, or pivoting to more reliable, if smaller, markets. And as trust is withdrawn piece by piece, no grand crisis is needed. A single silent wave is enough to sweep away an entire generation of prosperity built on trust in the rule of law. A silent but sharp response. While Washington still believes that relentless tariffs are tools to force partners into concession, Canada to the north is choosing a different way to respond. Not loud, not confrontational, but highly deliberate. From closed-door meetings in Ottawa to the economic corridors of Toronto, a new strategy is unfolding, not retaliating with statements, but strategically detaching itself step by step from the American economy. On July 10th, when President Trump abruptly announced a 35% tariff on all Canadian imports, not just steel, aluminum, or cars, but everything, Ottawa's reaction wasn't anger. There was no emergency press conference, no retaliatory tweet, just a short statement from Prime Minister Mark Carney. We will assess and act based on Canada's strategic interests. But behind that calm was a policy engine operating at unprecedented speed. In less than 2 weeks, Canada's Ministers of Trade, Finance, and Energy held meetings with counterparts in Singapore, New Delhi, Brussels, Seoul, and Tokyo. Gold shipments previously stored in New York were now being transported to London. Oil export agreements from Alberta, which once prioritized pipelines to Texas, were being rerouted to seaports for direct shipment to East Asia. Canada wasn't responding with tariffs, it was responding with rerouting. This transformation didn't happen in a state of emergency. It had been prepared long ago, as a contingency for this very situation. What makes it effective is the broad consensus within Canada. There is no partisan divide, no debate over whether to yield a little to maintain goodwill with the U.S. Because most Canadians now understand, trade relations with the U.S. are no longer a stable axis, they are a strategic risk. Numbers don't lie. According to Statistics Canada, in May 2025 alone, exports to the U.S. dropped 25% from January to 41 billion Canadian dollars. Meanwhile, exports to non-U.S. countries rose to 19 billion Canadian dollars, the highest since 2021. That's no coincidence. It is the result of newly opened trade routes, contracts renegotiated in other currencies, and transport schedules redrawn to avoid the U.S. border. It's not just oil or gold. Canada is also repositioning its entire pharmaceutical and agricultural industries. Canadian drug companies are shifting products to the Italian and German markets, where regulations are stable and surprise tariffs unlikely. Agricultural products from Saskatchewan and Manitoba are being retargeted to India, a nation with a large population and high demand for barley, soybeans, and chickpeas. Every shipment, every unit of product is being moved out of Washington's sphere, not as a temporary reaction, but as a methodical exit strategy. Prime Minister Mark Carney doesn't need to threaten. He doesn't need to call it retaliation. But everyone understands. If the U.S. uses tariffs to force partners to turn back, then Canada is using trade itself to permanently exit an unreliable orbit. And once that shift is complete, it won't reverse, not just because of lost trust, but because Canada has found a new path forward without the U.S. at the center. And that is the most profound counterattack of all, responding through structure, not through words. when Brussels no longer speaks with a conciliatory tone. If Canada's response was a quiet restructuring, then Europe chose a different path: cold, calculated, and ready to retaliate. In the corridors of the European Commission, no one talks about soothing Washington anymore. Instead, lists have been printed, detailed down to every product code and service line, to be targeted with retaliatory tariffs, not for negotiation, but for readiness to strike. When President Trump announced a 30% tariff on EU goods, Brussels didn't get angry. They simply shifted strategy. The $25 billion retaliation package that had once been put on hold in hopes of preserving a path for dialogue has now been replaced with a new list worth $72 billion, nearly 3 times larger. And what's more alarming than the number itself is the way targets were selected. Not agricultural products or consumer goods, but sectors the U.S. depends on for profit: financial services, digital technology, and intellectual property. This isn't just a trade measure, it's a strategic warning. The U.S. still prides itself on running trade surpluses in high sectors: software, banking, digital platforms. But Brussels understands that if they truly want to retaliate, they don't need to shut borders to physical goods. They just need to hit the places where America earns the most without producing anything: data services, e-commerce transactions, global payment systems, and dominant cloud platforms. What's worth noting is that the EU doesn't want to take this path, but they are ready. In official statements, European leaders consistently emphasize, "We are not seeking confrontation, but we cannot remain passive when the rules of the game are being unilaterally overturned." And what should worry Washington more than whether Brussels will impose tariffs is the fact that Europe can rebuild global trade rules without the U.S. at the table. In 2025, the EU has signed new bilateral trade agreements with Japan, South Korea, Australia, and the Mercosur bloc. At the same time, it has expanded data partnerships with India and implemented digital taxation policies on American tech giants operating in Europe, from Meta and Amazon to Google. Washington has called this discriminatory taxation. But from the European perspective, it's simply a way to reclaim economic space they've ceded for far too long. By directly targeting sectors the U.S. once believed to be untouchable, Europe is sending a message that cannot be misunderstood. If Trump's America continues to treat trade as a game of unilateral power, then Europe will no longer play the role of a partner to be used. They will become an organized and equipped rival. From a transatlantic alliance once seen as inseparable, both shores are now entering a phase of economic separation. And if tariff strikes continue, that separation could become a structural divorce. Washington may still believe that the EU is waiting to return to the negotiating table. But in Brussels, that table has been cleared, and the seat for America is no longer one of honor. Fractures in the global framework. In ordinary trade disputes, damages can be measured in percentages: how much GDP declines, how much exports drop, how many points inflation rises. But what is happening between the U.S. and its allies is no longer a dispute. It is a fracture in the global economic framework, where not only the flow of goods is disrupted, but also trust, strategy, and the logic of cooperation are being distorted to the breaking point. The visible losses are already clear. According to the IMF, if trade relations between the U.S. and Canada and the EU fall into total rupture, U.S. GDP could drop by 0.4% in the first year alone, and up to 4% if factoring in the domino effects on long-term investment and the high-tech sector. But that is only the visible part. Beneath the surface lie changes that will reshape the map of production, supply chains, and global soft power over the next decade. Take the clean energy sector, a field the U.S. has placed its hopes on for post-pandemic recovery and to compete with China. From lithium in EV batteries to rare earth elements in wind turbines and AI chips, the U.S. is almost entirely dependent on imports, particularly from Canada, Australia, and select European partners. But with Ottawa beginning to review export licenses for strategic minerals, America's access to core input materials is under serious threat. Unlike tariffs, disruptions in strategic material supply chains cannot be resolved through executive orders or short-term negotiations. It takes 5 to 7 years to open a new rare earth mine. It takes a whole decade to rebuild refining and processing chains to industrial standards. And if partners choose to sign long-term contracts with Europe or East Asia instead of the U.S., the resulting shortages are not just economic. They are a blow to technological futures and national security. Similarly, in the semiconductor sector, American companies are gradually losing access to favorable sourcing of materials and clean energy from allies. If Ottawa stops supplying uranium for America's new generation reactors, or if Brussels restricts the transfer of AI platforms due to concerns over cross-border data control, companies like Intel, NVIDIA, or Google won't simply see profit margins shrink. They will lose their global competitive edge. We are witnessing a shift that is quiet yet fateful, from a global economy built around U.S.-anchored trust to a multipolar system where alliances are being reshaped without Washington's guarantee. And in this new ecosystem, trust is the most expensive resource. Once lost, it cannot be repurchased with apologies or short-term incentives. The scariest part is not that other countries are turning their backs on the U.S. out of anger. They are not angry. They are simply tired and no longer want to depend. And when strategic decisions no longer place the U.S. at the center, the global economic leadership Washington once held won't be snatched away. It will dissolve in its own hands. Because in a world powered by supply chains, data, and long-term strategy, a slip in trust can become a historic misstep. And today, the signs of that slip are no longer found on charts. They are being etched into every investment decision, every partner contract, and every industrial roadmap where the U.S. is no longer invited to sign its name. When power no longer comes from force. Donald Trump believes in pressure. From trade to diplomacy, from domestic to foreign affairs, he acts as if the world is a chessboard where whoever plays harder wins. Tariff letters, public threats, 35%, 50%, 70% tariffs. For Trump, these are expressions of strength. But the world in 2025 no longer reacts like the world of 1985. In a global system interconnected by technology, data, and cross-border value chains, pressure doesn't make countries kneel. It makes them turn away. Canada withdrew through a restructuring strategy. The EU struck back with smart tariff packages and prepared new rules that don't include the U.S.-Mexico, reduced its expectations for any long-term agreement with Washington. And above all, a new model is taking shape. A world no longer centered around America's attraction or power. Not because they want to resist, but because they no longer want to rely. This isn't an impulsive reaction. It's a structural adjustment process. A sophisticated resistance where allies don't shout, "We object," but simply don't call back. Don't renew contracts. Don't send conference invitations. They pivot toward ASEAN, sign agreements with India, accelerate digital frameworks with Japan, open trade routes with Africa. The rhythms of trade that once pulsed through Washington now flow through Singapore, New Delhi, Seoul, and Brussels. And what allows the world to move on without waiting for America isn't any specific declaration. It's the depletion of something that can't be measured in GDP. Trust. Trust that agreements will be honored, that a commitment made today won't be torn up tomorrow by a 3 a.m. tweet, that an alliance isn't a hostage to be bargained. When that trust disappears, leadership dissolves with it. Trump may still believe that if he hits hard enough, the other side will turn around. But he forgets that in geopolitics, not everyone turns back. Many simply turn away and never return. When he announces tariff rates like he's auctioning off a deal, he doesn't see that what's being traded away isn't just a few percentage points of import tax, but an entire ecosystem of influence the United States took half a century to build. The cost lies not just in trade, but in status. Once nations choose to shift foreign reserves to euros and yen instead of USD, choose European payment systems instead of SWIFT, choose local data platforms instead of Amazon Web Services or Google Cloud. Even if America lifts tariffs, they won't come back. Not because they hate, but because they found another way to live. A new economic model that doesn't need America at the center. And as the world keeps moving forward, perhaps the bitterest truth is not that America is excluded from deals, but that they're still there, and no one needs their opinion anymore. They aren't being punished, they're simply being ignored. In its effort to maximize power, the Trump administration is facing a strategic paradox. The more pressure it applies, the more isolated it becomes. The more it swings the stick, the more influence it loses. And while the White House keeps repeating the slogan, "Make America Great Again," the rest of the world is quietly redrawing the trade map, with Washington no longer at the center. Because in the 21st century, true power doesn't come from coercion, it comes from the ability to preserve trust. And that is what America, under its current policy, is losing day by day.